I'm a 21-year-old senior in college. I'll be working in investment banking post-graduation, and I have the goal of being financially free in my 30s. Part of this journey is having incredible financial literacy and knowledge when it comes to financial products to make sure that I can use them to my advantage. Today, I want to discuss arguably the most controversial financial product, credit cards. So credit cards are known to be these evil form of payments that banks made to prey on people and ensure that every person is stuck in this endless loop of high interest debt. To some extent, it is true if you don't know how credit cards work. If you don't know how they work, they become one of the easiest ways to fall into an endless cycle of debt and interest. The average American carries over $7,000 in credit card debt with an average interest rate of 25%. Meaning for every $1,000 you don't pay off, you're paying over $250 in interest a year. Not exactly $250, and I'll show you why in a bit. However, the problem isn't credit cards themselves. It's people using it like free money. So how do credit cards actually work? Think of them as a short-term loan. The bank is basically lending you money for a month, and if you pay it all back by the due date, you pay zero interest. It's as simple as that. So let's go over a few key terms that you'll need to know. There's the APR, which is your annual percentage rate. This is the yearly interest rate that you'll pay on your balance if you don't pay that balance in full. Then there's the minimum payment. This is the smallest amount you must pay back each month to the bank to not get charged a late fee. This minimum payment is usually 1 to 3% of your total balance. However, keep in mind that you will still get charged interest on the remaining amount. Paying only the minimum balance keeps you in debt for much longer. Then you have the statement balance. This is the total amount that you owe for the entirety of the last billing cycle. Smart credit card users pay this in full to avoid any interest and fees altogether. Then you have the annual fee. Some cards have an annual membership fee to use them, and in return, you get benefits for having the card, things like lounge access, coupons, credits, discounts at different stores, higher cashback rates, among other things. And then finally, you have your credit limit. This is the maximum amount of money you can borrow at once on the credit card. There are a lot more credit card terms which I would highly recommend you take a look at. I'll put a CNBC article down below in the description. Moving on, every card also includes something called a Schumer box. It's basically a standardized summary of fees, interest rates, and penalties for your card. Ideally, you shouldn't even have to look at this information because it wouldn't matter to you if you pay your statement balance in full. As part of understanding how credit cards work, you should also understand how the interest payments work. Earlier, I mentioned that a 25% APR doesn't exactly mean you'll pay $250 in interest on a $1,000 balance. This was because of a concept known as compounding. Since credit cards charge interest every day or every month on the balance you carry, what you will actually end up paying is known as the effective annual rate, or EAR, which is the interest rate that takes into account compounding. So going with the same example, we carry a $1,000 balance with a 25% APR, and we assume the credit card charges interest daily. What most people would do is this, and they'd come to the conclusion that their annual interest payment is $250, which is wrong. This is what it actually is. So you can see you're actually going to be paying $33.91 more than what you expected. This is the part that fools most people. They expect to pay a certain amount and then are surprised when their interest payments are higher than what they expected. This is the direct result of a lack of financial literacy education in schools. Now that we've gone over that, let's go over your credit score. Your credit activity is reported every month to the three main bureaus, Experian, Equifax, and TransUnion. They use this data to calculate what's known as your credit score. This affects your ability to get loans, rent apartments, or even get jobs. So what actually impacts your score? It's this. 35% of your score is impacted by your payment history. 30% is affected by your credit utilization. 15% is affected by the length of your credit history. 10% is affected by your credit mix, so how many different loans and types of loans you have. And then finally, 10% is affected by the amount of new credit that you have, or hard inquiries. What does the credit card payment timeline look like? So for example, let's start at December 1st, which will be the start of billing period 1. Here, we have a balance of $0 and a credit limit of $5,000. On December 10th, we make a $1,000 purchase, which means our outstanding balance will then increase to $1,000. On December 31st, we reach the end of billing period 1, and your statement balance is printed. Since we spent $1,000 that month, our statement and reported balance is $1,000. Our credit utilization will come out to 20%, which is $1,000 over $5,000. The statement balance will then be due within 21 to 30 days. The specific number depends on your bank, and say in this case, it's 28 days. So on January 28th, you'll be required to pay off the entire $1,000, and the cycle repeats every single month. Now that we've covered how credit cards work, let's get to the crux of the video. Here's why credit cards can save you money and can be incredible if used effectively. Firstly, there's the rewards. Credit cards can give big sign-up bonuses, cashback, points, discounts, and a lot more just for spending on and having the card. For example, I earned about $1,300 in sign-up bonuses earlier this year from my Chase Sapphire Preferred. They had an incredible offer for 100,000 points, which is worth at a minimum 1 cent per point, so $1,000, and then another $300 offer from Rakuten. Those 100,000 points can easily be redeemed for a value of more than 1 cent, which only increases the value of getting the card. There's actually this concept known as churning, in which people mass apply to credit cards just to get the sign-up bonuses because the amount of cashback you get is significantly higher than normal. For me to get the 100,000 points, I had to spend $6,000 within 3 months, which was fine for me because I spent that amount anyway. Keep in mind that you should never open credit cards just for the sign-up bonuses if you cannot hit the minimum required spend organically, as in, you would have spent that amount of money anyway. Secondly, there's the protections. There are fraud protections, there's extended warranties, there's the ability to charge back, and there's insurances like travel and auto insurance. And then finally, it's the convenience. It helps you build your credit score, making it easier to get loans in the future. There's global acceptance. It's safer than carrying large amounts of cash, and some credit cards even waive foreign transaction fees, making them great for travel. Debit cards in comparison offer none of this. There's less fraud protection, there are no rewards, no insurance. If your card is stolen or your bank account is hacked, your cash is more than likely gone. This doesn't happen with credit cards because the money you're using is the bank's money. Once you flag the bank about fraud on your card, it is not your responsibility anymore, and the bank will do everything in its power to get their money back, while you get to keep your account and money safe. I also think it's important that you understand why banks give you all of this free stuff, just to make sure it doesn't seem like some kind of Ponzi scheme. So obviously banks wouldn't offer any of this if it didn't make them plenty of money. They make money from 2 ways on credit cards. Firstly, they make money from interest from people who carry balances from month to month. Those 25% APRs add up fast, and these are usually from people with low credit scores. Secondly are the interchange fees. These are small transaction fees charged by the bank every time you swipe your card. But, good news, you don't have to pay any of these. They are paid for by the merchant that you shop at. In this case, banks are incentivized to keep you swiping your credit card, and people with high credit scores make up the bulk of this revenue. The benefits being given on premium credit cards to those with high credit scores are essentially being subsidized by those who don't pay their balances in full. You do not want to be the person that ends up funding somebody else's international holiday. So now you've heard me talk about how great credit cards are and you just start playing the game. This is how you start. First, you start off with secured credit cards, especially if you have no credit history or banking history with a financial institution. How secured credit cards work is you put down a deposit as collateral, and that collateral becomes your limit. If you give the bank $100 as your deposit, your credit card limit will then be $100. If you ever end up not paying your balance back, they get to keep that $100 deposit. So it protects the bank and also gives you a chance to build up your credit. These are cards like the Capital One Quicksilver Secured. After that, after building some credit, after building a history a bit, say after 6 to 12 months, you can move to no annual fee unsecured cards. These cards don't require a deposit and start giving simple cashbacks on your spending categories like dining, groceries, entertainment, and others. These are cards like the Freedom Unlimited, Capital One Saver, or the Wells Fargo Autograph. Most people will actually have the bulk of their credit cards in this bucket. Then you can move on to low annual fee credit cards. This is where you start earning points on your spending and can then redeem those points for flights, cruises, hotels, and activities. These cards include the Amex Green Card or the Chase Sapphire Preferred. Finally, you have the high annual fee credit cards, which give the most benefits, perks, and points on your spend. These credit cards often have annual fees of well over $300 and are primarily targeted towards people who travel a lot. These are cards like the American Express Platinum, the Capital One Venture X, or the Chase Sapphire Reserve. You should only be getting these credit cards if the value of the benefits you will use outweigh the annual fee. Now, there is a tier above all of this, which includes cards like the JP Morgan Reserve or American Express Centurion, more commonly known as the Black Card. However, these credit cards are well beyond the realm of the average person, each requiring hundreds of thousands of dollars in spending a year or millions of dollars in deposits with the bank. I'd also just like to let you all know that this video is not sponsored, and the credit cards that I'm naming are just examples of credit cards in each of those categories. Finally, what does my credit card setup and path look like for a 21-year-old senior in college? So my credit card journey started last year. In 2024, I started off with the Freedom Rise from Chase, an unsecured credit card with a very low credit limit and limited cashback. Later that year, I got the Capital One Saver, which had a much better offering of cashback categories, including 3% back on grocery, dining, entertainment, and streaming. Frankly, the perfect categories for a student. I also got the Prime Visa card from Chase because I had an Amazon Prime subscription and ordered off the site pretty frequently. Paying with the Prime Visa card gave me 5% back on every purchase I made on Amazon. And then in 2025, after 1 year, my Freedom Rise got upgraded by Chase to the Freedom Unlimited, as I paid my credit card bill on time every single time. The Freedom Unlimited then increased my credit limit and broadened the categories in which I could get a higher cashback. Up till now, all of these cards are with no annual fees. The latest credit card that I got was the Chase Sapphire Preferred, being my first annual fee credit card with an annual fee of $95 per year. I'd actually not planned on getting the card, but there was this really good offer that I'd mentioned earlier in the video, and I knew I could reach a spend requirement without putting a strain on my budgets. So I decided to get the card, and the sign-up bonus now covers that annual fee for almost 14 years. With all of these cards in my arsenal, I pretty much always get a minimum of 3% back on all my spend. The next card that I intend to get once I start my job will be my first high annual fee credit card, either the American Express Gold Card or the Capital One Venture X. So all in all, credit cards are not evil, and they can actually be a very powerful tool if used correctly. I want you guys to comment down below and let me know what you think of credit cards and the information I've told you in this video. I want us to have an open discussion and help each other out. And if you've enjoyed the video, feel free to subscribe, like the video, and I'll see you guys in the next one.